Hi again, Stan Ehrlich, and now we're going to talk about key reversals. They are also called outside trading range days. They are also called, if you're looking at a candlestick chart, an engulfing line, because the three important parts to this type of one day, very profound, it is my favorite reversal. If you don't learn anything else from these video sections and these chapters, this one is the one you should take home. This one you should concentrate on. You will see this type of reversal happen relatively frequently in all types of markets all around the world, and I have a very specific, exacting way of treating this reversal that has been working very, very well for a long period of time. As a matter of fact, it was one of my best signals that I use constantly in the Ehrlich Report, the daily research that I put out for Solid Gold Financial Services. Let's start. On the chart that we're looking at, which happens to be the Euro-Dollar chart, for the moment we can disregard the comments that I've got right here. They're not important to the key reversal and the green line that we have here and here and here. They're not important at the moment, but I do want to leave them on the screen. This is the day that's important. This is the day that the market got above the previous day's high. That's the first thing in an uptrend you want to be aware of. It's making a new high for the trend. At that point, there's nothing wrong. There's nothing that looks like the market's going to turn around and start to go down. That's extremely normal for a bull trend. But if you also see in the same day that the market gets below the previous day's low and closes lower than the previous day's closing price, you have what should be, what could be, a turning point, a top in the market. This is considered to be a bearish key reversal because it closed down while the previous major move was up. I also like to see, accompanying this type of reversal, a technical situation we call overbought. And I will have a separate chapter, which you may have already seen or you can see, on oscillators and what we call overbought and oversold conditions. So when this reversal happened, the market was in an overbought condition, which adds to the validity, it adds to the likelihood that this is going to be a profitable bearish signal. It doesn't guarantee a thing, it adds to the probabilities that it's going to work very nicely. So a higher high, a lower low, and a lower closing are the basics for a bearish key reversal, and this is exactly what I do with this particular reversal. I put a buy stop one tick above the high of the key reversal day for protection. That is where I'm going to get out of my short positions that I may be putting on during the next days. I put an offer to sell short exactly in the middle of the range of the key reversal. You can calculate the price by taking the high of the day. As you can see here in the rectangle just to the lower right of the pointer, for this particular date, the high of the day was 129.70, the low of the day was 127.79. You can add the high to the low and divide by 2, and you will get the mathematical middle of this day. If it's a half tick and it's a bearish key reversal, put the price down a half a tick to get a legitimate price on your order. If it's an up day and there's a half tick involved in the calculation, add a half a tick to become a legitimate price for the broker to take the order with, or the software trading system to accept. So the mathematical middle might be, on occasion, a half a tick. All right, so I'm trying to sell short in the exact mathematical middle of this day. And it looks like I either got the exact high of the day this next day, or easily was able to sell short in the next several days, just from a visual standpoint, without even doing the math. Obviously, that's available 2 days later. I also place a second new short order. This was an offer to sell short in the middle of the range. This order is going to be 1 pip or 1 tick below the low of the key reversal. It is going to be selling short again with using a sell stop is the type of order that I am going to use to get short. I will place a sell stop, a new short sell stop, 1 tick below the low of the key reversal day for the next day or the next day or the next day, unless it makes new highs and I'm out of the trade completely. I will have sold short here. I would have gotten stopped out and this order is not filled. That happens sometimes. Then I cancel it. But in this case, you can see that I sold short probably close to the low of this day, and on the same day I might have sold short again on the rally, or possibly it was the next day. But now I'm short 2 contracts, one right here and one right about here, and as time passed, this market started to head substantially lower. Also, I want to point out to people that this is a double top formation across these 2 highs. The highs are almost exactly the same. The high here is 129.70, and the high on this day is 129.79. They're only 9 pips, which is a very small amount, apart, covering 1, 2, 3 full weeks. So we will talk about double tops in another chapter, but it is interesting to note that it started with this bearish key reversal. I have seen plenty of occasions where you might have had a bearish key reversal as the second high in a double top, or involved in the high of a shoulder or the head or the last shoulder of a head and shoulder top formation, or it's just simply a key reversal that starts to decline immediately and there's no other particular formation involved. We might call that a spike top, where the market rallies straight up and then drops straight back down again. And sometimes you'll find this key reversal exactly on the high day. It has money management built into it. You know where to put your buy stop, at least at first. You know where to sell short, the middle of the range of the key reversal, plus a new short sell stop 1 tick below the low of the key reversal. So you may end up with only 1 short if it goes straight down and you can't sell it in the middle of the range. Or you may end up with 2 short positions, one in the middle of the range of the key reversal and one just below the low of the key reversal. As the hours and the days pass, I use what's called a trailing stop technique. We'll talk about that in another chapter, to immediately lower my risk and very quickly, hours to days later, begin to lock in, and I use the word lock in a generous sense. If I'm filled at the price on my stop order, then idealistically I've locked in a lesser risk, a profit, more of a profit as the market continues to work its way lower. So this key reversal is extremely important. I'm going to show you an example of a key reversal that is a bullish example. This happens to be the US dollar to the Japanese yen, the exact low day of this previous substantial decline, and the beginning of that rally, of which we are currently trading right here, is a bullish key reversal. You have a lower low than the previous day's low, and in this particular case it is lower for the whole trend, not just the previous day. You have a high higher than the previous day's high, and you have a closing price higher than the previous close. Now this high can be only 1 tick higher. Usually I'd like to see more than that, but it can only be 1 tick higher if it happens that way. This can be possibly 1 tick lower than the previous day's low. Usually it's several ticks or more, or pips that is. And the settlement price or closing price at the end of the trading session can be only 1 pip higher than the previous close. That's the minimum requirement for an outside up day. This is obviously much better, significantly higher, substantially lower, including a new low for the trend, and a higher closing price by a substantial amount than the previous day's close. It's an idealistic, right out of the textbook key reversal. Plus the market was substantially oversold for a couple of weeks before this reversal happened, which is an added plus. Remember on the other bearish key reversal example, I said the market was overbought, but with bullish key reversals, you want the market to be oversold, not overbought like our current week or so has been because of an uptrend. All right. Now, I tried to buy it in the middle of the range the next day or 2 or 3, but the market would not come back into the middle of the range. The next day, it didn't even make a higher high, so I have no fill whatsoever on this day. Let me please draw the lines in for your new long buy stop right there. The middle of the range of the key reversal is approximately there. And of course, my protective sell stop is immediately one tick or one pip below the low of the key reversal. So I never bought it here, unfortunately, erasing that line, but I certainly bought it on this day, when 2 days later it ran above the key reversal high. The next day, it slipped back slightly, and I still had a small profit, but a little less than the previous day. And now, over time, it first stalled out for a little while, but then it started to trend higher very, very nicely. And on a longer term basis, I never ran into any problem with this key reversal, past tense now by over a month, having been the profound turning point for this move so far on this particular chart, the US dollar to the Japanese yen. So here's an example of a great bullish key reversal happening. Again, I want to impress upon you, please, this is my favorite single day reversal. It only takes 1 day to happen. You will find it in many chart formations as part of the formation. You will find it at the exact high day or the exact low day of turning points in markets that may last days on a short-term basis, weeks, or maybe even months into the future. And usually you get very substantial swings as a result of these key reversals, especially when they work great, obviously. When they don't, you have a money management technique. You are starting to move your trailing stop to limit your risk and eventually lock in profits. And just keep doing that. And again, we'll discuss trailing stops and money management and the philosophy behind it in another chapter. Thank you very much.